Ladies and gentlemen, good day and welcome to the Baazar Style Retail Limited Q1 FY25 earnings conference call. As a reminder, all participant line will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suyash Saman from Stellar IR Advisors. Thank you and over to you, sir.
Good evening everyone and thank you for joining us today. I have with us today the senior management team of Baazar Style Retail Limited, Shriyan Surana, Managing Director, and Mr. Nitin Singhania, Chief Financial Officer, who will represent Baazar Style Retail Limited on the call. Management will be sharing operating and financial highlights for the quarter ended June 30, 2024, followed by a question and answer session. Please note, this call may contain some of the forward-looking statements which are completely based upon our beliefs, opinions and expectations as of today. Statements are not a guarantee of our future performance and involve unforeseen risks and uncertainties. The company also undertakes no obligation to update any forward-looking statement to reflect developments that occur after a statement is made. I now hand over the conference to Mr. Shriyan Surana. Thank you and over to you, sir.
So hello everyone, good afternoon. I welcome you to the maiden earnings call of Baazar Style Retail Limited to discuss Q1 FY25 performance. I am delighted to speak to you all for the first time after a successful listing. I hope you have all gone through the results and the investor presentation which is available on the stock exchange and on our website. As this is our first earnings call, I would like to take a few minutes to take you through our business model and the journey we have undertaken so far. With the thought of revamping India's wardrobe and fueling the economy, Baazar Style started in 2013 to cater the aspirational needs of real Bharat, that is Tier 2, Tier 3, Tier 4 towns of the country. And while doing that, we became one of the fastest and the largest growing value fashion retailer, both in terms of store count and revenue from operation. We started our journey in 2013 from a small store in Berhampur, followed by 184 stores as on 30th September, with a retail space of around 16.66 million square feet across 158 cities. With an employee strength of around 2600 plus people, an office space of around 30,000 square feet, and a warehouse of around 1.8 lakh square feet, we aspire to reach the zenith of fashion evolution in next 5 years. In terms of product offering, we have got it all covered under the umbrella of Style Baazar, from stylish menswear to elegant women's wear to adorable kids wear and all household related articles, plasticware, toys, etc. In the last 12 years, we have made Bharat stylish and aspire to keep up with the trend in future also. In 2013, we embarked on a journey of growth and innovation when we opened our first store in Berhampur, West Bengal. A humble beginning that set the stage for our future. By 2016, our expansion continued as we opened our maiden store in Odisha. That year, we celebrated crossing an aggregate of 0.10 million square feet of retail space with our revenue soaring past 100 crores. With a solidified presence in East India, the year 2018 marked a significant milestone as we raised funds from late Rakesh Jhunwala, Intensive Fiscal Private Limited and other marquee investors. The support enabled us to launch stores in different geographies, doubling our store count to 72 stores in 2019, and we crossed the revenue of 500 crores in FY 2019. Fast forward to 2024, we have now crossed an aggregate of 1.4 million square feet with a presence of 162 stores across 9 states, paving the way for an even stronger market presence. In Q1 FY25, we opened 4 new stores in Assam and Bengal, taking the total store count to 166. And as on 30th September, we have got 184 stores across 9 states and 158 cities. Our greatest strength lies in our cluster-based strategy for rapid store expansion. This is one of the key strengths and strategy for the company, which has allowed company to deeply understand the local areas, adapt to their customer preference, and enhance brand visibility. The power of clusters has also helped us to optimize marketing expenditure and supply chain expenditure, and also optimize on the inventory side. In terms of market, we have got two markets. One is core states and one is the focus states. So primarily West Bengal, Assam, Bihar, Odisha are our core states, and where we have a decent presence. And the focus states are the growing states like Tripura, Jharkhand, UP, Andhra Pradesh, and Chhattisgarh. Our goal is to bridge gaps in untapped areas of the core market while also exploring the new territories in both core and focus market. This approach enables us to stay competitive and achieve the best possible results both in terms of profitability and revenue. In terms of product, having a deep understanding of customer preference allows us to curate a comprehensive and a targeted product mix that resonates with our audience. By analyzing the trends and feedback from our customers, we can offer a diverse range of products that meet the varying needs and desire of our customers, ensuring that they find exactly what they are looking for. Our product range includes fashion apparel for men's, women's, kids, athleisure, bottom wear, ethnic wear, night wear, and wearables. Then there is a general merchandise which includes home decor, household products, home furnishing, home appliances, and accessories, that is bags, travel, accessories, lifestyle products, and footwear. We strive to create a one-stop family shopping experience where customer can find everything that they need under the one roof for the entire family. By combining quality product with affordable pricing, we make shopping convenient and enjoyable for our customers, ultimately leading to increased satisfaction and loyalty. This approach positions us as a go-to destination for families, encouraging repeat visits and long-term relationship built on trust and value. Coming to share a little more details on the private label, we have got 10 private labels, that is Square Up for men's and boys wear, Wolsey and Cutter again into the men's apparel, Avaya is for the ladies ethnic wear. Square Up is one of the largest brand that we have in the private label, which stands at 117 crores of revenue as on FY24. From FY20 to FY24, our private label segment has experienced impressive growth of approximately 64.6%, contributing to 38% of our overall revenue. These have also enabled us to achieve better profit margins. In terms of growth strategies for the future, as you can see that the market is big enough. As per Technopack report the North and the East region market share for value retail is expected to grow from 3,09,000 crores in FY24 to 4.58 lakh crore in FY27, which is a CAGR of 15%. To build on this ever-growing industry demand, we have some strategies in place to add our growth. We aim to expand our store count further through deeper penetration in core markets and forming new clusters in focus market to our strengthened market positions. We would like to continue to invest in strengthening our supply chain management and human capital to further reduce our operating costs to further optimize our supply chain management. The intent is also to focus towards creating differentiation and achieving greater control over the product quality through private labels. This fosters a sense of trust and loyalty among our consumers. Also, we continue to improve our operational efficiency through investment in technology adoption initiatives, data analytical capabilities, and implementation of an omni-channel retailing business model. With that, I would like to conclude my opening remarks and request our CFO, Mr. Nitin Singhania, to take over to explain the financials.
Thank you, Saranji. Good evening, everyone. Now I will begin by sharing operational highlights and key financials numbers for the quarter ended on June 30th, 2024. Starting with the financials for Q1 FY25, the total income at 279 CR was up 22% Y-on-Y and 24% quarter-on-quarter. Gross profit at 91 CR, up 22% Y-on-Y and 25% quarter-on-quarter. EBITDA at 42 CR, up 23% Y-on-Y and 78% quarter-on-quarter. EBITDA margin at 15.2%, up by 20 BPS Y-on-Y and 460 BPS quarter-on-quarter. PBT at 11 CR, up 33% Y-on-Y and 215% quarter-on-quarter. Loss after tax at 0.4 crore impacted due to exceptional loss on account of provision of loss of 11 CR due to fire in one of the warehouse and insurance claim still awaited. Coming to the key financials metrics, in Q1 FY25, we continue to witness healthy volume growth overall and strong growth in private label sales. The private labels contribution increased from 37% in Q1 FY24 to 52% in Q1 FY25. In absolute term, it is at 145 CR, up 70% Y-on-Y. The store count grew 19% Y-on-Y to 166. The rental area of the stores grew 15% Y-on-Y to 1.05 million square feet. The average store size in square feet stood at 9,032. The total number of bills grew 27% Y-on-Y to 3.08 millions. The quantities sold grew 20% Y-on-Y to 10.29 millions. The average transactions value stood at 949. Same store sales growth stood at 5.5%. As we speak, for FY25, which is also available in public domain, some key highlights are revenue grown by 65% Y-on-Y to 311 CR in Q2 FY25 and 41% Y-on-Y to 586 crore in H1 FY25. Sales per square feet stood at 708 per month in Q2 FY25 and SSG at 41% in Q2 FY25 and 21% in H1 FY25. Total number of stores stood at 184 as of 30th September 2024. The company opened a total of 21 new stores and closed 3 stores during the quarter FY25. In addition, over the past year, revenue grew at a CAGR of 33% to 973 crore in FY24, gross profit at 36% CAGR to 326 crore, forming a healthy gross margin of 33.5%, EBITDA at 44% CAGR to 142 CR with an EBITDA margin expansion of 220 BPS to 14.6 in FY24. Profit after tax has improved multifold to rupees 22 crore from 5 crore. We have a healthy return ratio with ROCE at 18% and ROE at 11%. To this note, now I conclude our presentation. We will endeavor to continue with this growth momentum going forward. We thank you a lot for listening us affirmatively, and now we open the session for question and answer to you all. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Arpit Shah from Stallion Assets. Please go ahead.
Hello.
Yes, sir.
Am I audible?
Yes.
Yeah, congratulations on very good set of numbers for H1 FY25. I had a couple of questions. If you can just walk us around the unit economics of a store. What is the payback like? What is the ROC like? And how does the unit economics work in terms of sales per square feet, cost per square feet, gross margins and everything? That would be my number one question. Number two question would be around seasonality of the business. What is Q1, Q2, Q3, Q4 typically as percentage of saliency in terms of sales? If you can help in that number. And any guidance you all are sharing for PAT or revenue for FY25 and FY26, because since we have seen a very, very strong H1 FY25 with almost 41% growth, so what kind of numbers can we see for FY25? And even your competition has also reported good set of numbers, be it V2 retail or V-Mart. Is there a large change happening on the ground for tier 2, tier 1 kind of economies where the demand has actually started picking up, or is there a seasonality factor in play for other peers and as you as well?
So answering to your first questions about the store unit economics. So typically, if we see a store size of 7,500 square feet, so sales per square feet is around 7,500 square feet with an store EBITDA pre-Ind AS at 13%, which will come out to be 7.34 million. And if we take the capex of only capex, the payback period will be around 16 to 18 months. So capex investment is around 1 CR, and with inventory it will be around 2 CR, and it will be between the payback period including inventory will be 31 to 36 months.
Sorry, the capex is 1 crore and inventory is 2 crores. So 1 plus 2 crores, 3 crores, right?
No. Capex is 1 crore and 1 crore is the investment on inventory.
Total capex is 2 crores and 75 is it, let's say the average store size, you will be spending about, you said your sales per square feet is 7,500 rupees, right?
Yeah, 75 to 7,800.
And what will be the gross margin?
Gross margin will be around 33.5, which was already there in for FY24. So 33.5% gross margin.
And how do we walk down in terms of operating costs and everything?
Operating cost generally lies between, including rental, it lies between 20 to 23%.
20 to 23% is our operating cost.
On pre-Ind AS.
Pre-Ind AS, got it. And your payback is 31 to 36 months, including inventory.
Yes.
Got it. If you can just help me with the seasonality of the business.
Yeah, hi. Thank you for your question. In terms of seasonality now, because we are a Eastern India brand and there are lots of festivals in the East India, so there is a seasonality factor in the growth. If I tell you about last year, so in last year the Durga Puja, which stands at October 23rd last year, and which is right now on 13th October. So the 10 days seasonality factor is in this quarter in terms of growth, which cannot be quantified. But yeah, that's the regular practice which comes always sometimes in this quarter and sometimes in the third quarter. Coming to the question in terms of revenue, so the first half generally tends to have 43 to 48% of the revenue, depending on the seasonality.
40 to 48%.
Yeah, the first half.
Got it. And what should be the PAT guidance for FY25, the revenue guidance?
It will be between 3.5 to 4% before exceptional loss.
At pre-Ind AS levels. And in terms of revenue growth, our guidance would be around 25%.
So around 1250 crores, the sales number that you're estimating. With that, the pre-Ind AS PAT would be around 47 crores, broadly, 47 to 50 crores.
Yeah, pre-Ind AS.
The percentage that we are projecting.
Yeah.
And the Ind AS PAT would be how much?
Between 2.5 to 3%.
And what was the pre-Ind AS number for FY24?
Pre-Ind AS numbers for at EBITDA level for FY24 was 7.4%.
No, what is the PAT number pre-Ind AS FY24?
Sir, it is 2.23. Ind AS is 3.03. Sorry, 3.03. 29 CR.
At pre-Ind AS.
At pre-Ind AS.
Got it. And you see an impact of Navratri in Q3, right? Q2 did not. What was the reason for jump in Q2 revenues for across the sector, be it retail or V-Mart or anything?
I think there are lots of things which is happening in tier 2, tier 3, tier 4 towns. According to me, if you ask me, I think there's a huge shift coming from unorganized to the organized market. We are seeing a lot of traction coming from that particular space. Apart from that, with the scale, we have built our team that way in terms of merchandising, in terms of designing, in terms of price positioning. I think all these factors are leading to this growth. It's just not the seasonal situation that has led to this much growth. Otherwise, also if you see for the entire half yearly, it's 41%. The growth has been 41%. So there are lots of customers flowing from unorganized to the organized market.
Got it. So even Q3 we'll be able to see some quarter-on-quarter growth, right? Given that we are seeing a very strong traction of customers and footfalls. So is it good enough to assume that Q3 is also we're going to see a quarter-on-quarter growth?
See, I can just tell you about the full year. As I said, the 25% will be the growth that we will be chasing for this entire financial year. And yeah, there are lots of festivals both in Q2 and Q3. Q3 has got a lot of festivals. So that can only I can share right now on the call.
Sure. Thank you so much, Mr.
Thank you. The next question is from the line of Chintan Shah from GM Financial Family Office. Please go ahead.
Hi, thank you so much for the opportunity. So first question is more in terms of strategy. So we understand that we are more present in tier 3 and 4 towns, that also in the eastern region. So wanted to understand what is the potential in terms of revenue per square feet that we can drive over the next 2-3 years, and what initiatives we are taking to improve this, or is there any trends that are playing out that is helping us to reach that? So what's the potential that I want to understand?
See, in terms of potential, the East India has got a lot of potential. As I already said, that 3,09,000 crores is the market cap as of now on the value fashion retailing as on FY24, which is supposed to be at 15% CAGR. And in that too, also the unorganized penetration, the organized penetration is very less, and the people are moving from unorganized to the organized, all the consumers, which is helping us to have this growth. Now coming to the question in terms of sales per square feet, in our model, what we do is that in terms of tier 2, tier 3, when we open a store, it's more about EBITDA per square feet than the sales per square feet that we take as a benchmark, because in tier 2, tier 3, the rentals are comparatively very low than tier 1 and metro cities. And that is why the metro and tier 1 will have a higher sales per square feet compared to tier 3 and tier 4, but the EBITDA percentage would be higher in tier 3, tier 4 compared to the metro and tier 1. So it is very subjective depending on the sites that we are opening. And the strategy for going forward will be the cluster-based approach only. So we will be keep focusing on these 9 states that we are in. Apart from that, if there is any extension to these states, for example, if there is a store that we have to open in the northeast part, we would like to go over there. There is no issues in that, because the assortment that we are planning, it will be suiting that particular region also. The intent will be to grow in the existing region itself.
Okay, got it. Understood. And secondly, I wanted to understand in terms of competitive intensity in other areas that we are present in. So in terms of organized retail, how do you see the competition shaping up? And also, more specifically, just wanted to understand if Zudio is present, say, in any of the regions or near our stores, and if you have seen any impact or traction from there, if you can help us understand.
So in terms of geographical presence, yeah, we have got lots of stores areas where the Zudio is also present. But I think the market is big enough for everyone to stay, and there are lots of difference between us and Zudio also. Zudio is targeting majorly Gen Z consumer and focusing on everyday wear. We are more like a family-oriented shopping, where you can get ethnic also in our stores for the ladies. You can get kids collection also in the stores, which primarily Zudio doesn't offer. So as a result, we both coexist in there are lots of places, and where we both are doing good, both in terms of revenue and in profitability, and that's so.
So we try to say we haven't lost any business because of say Zudio being present in our region.
Yeah, we haven't, because see, what we do is that now whenever we open a store in a cluster-based approach, we try to understand the consumer preference, and we try to create the assortment as per their festival needs. Whereas the Zudio model is like a day-to-day wear articles, more focusing on Gen Z, which is below 30 years of age, and our target is to cater the entire family. So we have got all the product ranging from ethnic section to a formal shirts category to a festive wear articles. So I think that is the difference between us and Zudio. And certainly the kids, for example, there is no kids wear in Zudio.
Okay, got it. Understood. So just one last question from my side. So if you see the Q1 numbers, so the private label mix has grown from say 37% last year to somewhere around 52%. And ideally, I believe this should be margin accretive. But if I see the Q1 numbers, our margin is similar to what we reported in last year's quarter. So if you can understand why has this happened?
So basically, it's a pure strategical call that we have taken because we want to establish our private label brands in the market, and we have gone for an aggressive pricing on that structure. So we want to, that's why we have increased it from 38 to 50, around 52% in the Q1. and the guidance for this year will be also to go, the range will be 45 to 50%. So we want to expand our private label share, and we want every consumer to take the private label articles and to experience that article, and next time when they come, they ask for that article itself in the store.
Okay.
And after that also we have the 0.2 basis point has been an increase in the gross margin from last quarter.
Okay. So from a long-term perspective, what sort of mix we are looking at from private labels? And if you can also help us if they're going to go aggressive in pricing. So in terms of margins, basically what will be a guidance for the 2-3 year perspective?
So in terms of margin, our margin will range from 33 to 34% for the entire financial year. And the guidance for the private label contribution will be between 45 to 50% for the entire financial year. FY25.
Okay. Okay, fine. Yeah. Thank you.
Thank you.
Thank you. The next question is from the line of Kapil Jagasia from Trust Mutual Fund. Please go ahead.
I hope I'm audible.
Yes, sir, you're audible.
Yeah. Couple of questions from my side. How much these core and focus states would be growing for you, and what would be the trajectory going ahead? That would be the first question. And second question would be this accidental fire event. Any reason for this non-intimation? Because during the IPO, this thing was not mentioned. And any spillover of this event on earnings for Q2?
Sir, regarding warehouse fire, the same was disclosed under the risk factor in the offer document, where we have said that 50 crore of inventory was burnt out and 8 crore of PPE was also, we haven't loss of that. So that was covered in the offer document. And regarding that, we have taken 10.76 as the exceptional loss, being keeping prudence in mind. So our stat auditor has also suggested that we should take the loss which are not covered by the insurance company. So as in prudence, we have taken this into accounts.
Okay. And any spillover seen in this Q2 quarter?
Regarding the revenue, in terms of revenue, you are asking?
No, in terms of provision or anything would be there in Q2, or everything is covered in Q1?
Everything has been covered in Q1.
Sure.
And in terms of core and focus that you asked, so in terms of core states, in terms of focus states for Q4 FY24, we had 33 stores, and for FY24 we were at 121 stores. Am I audible?
Yes, and how they would be growing separately, the core stores growth and the
basically the focus will be to grow core at a higher level where we are present. The states like Bengal, Assam, Orissa and Bihar, and the focus states majorly is UP and Jharkhand, which is a growing state for us. So I think the ratio typically you can say is that around 70% stores are typically gets opened in the core and 30% in the focus.
Right. So the mix would be kind of similar for the whole of FY25?
Yeah, you can assume so.
Sure. And how much would be the full price sales for us with this private label contribution going up? Would we be seeing this contribution also increasing?
So for FY24, it stands at around 86% of the sales came from the full price sale too for FY24, and I think we intend to maintain the same rate for this year also. Little bit on the better side, you can say.
Sure. That's it from my side. Thank you so much.
Thank you.
The next question is from the line of Palash Kawale from Nuvama Wealth. Please go ahead.
Hope I'm audible.
Yes, sir, you're audible. I would request you to please use your handset.
Yeah. So congratulations for a good set of numbers, and thank you for the opportunity. So my first question is on a store count. So how do you see store count panning out in, say, next 2-3 years?
So on an average, we would like to grow between the range of 40 to 50 stores every year.
Okay. And in terms of gross margin, do you plan to maintain the similar gross margin for upcoming years also?
For this year, the guidance would be between 33 to 34, and on the coming years, there will be a little increase in the margins.
Okay. And so my next, most of my, like all my doubts have been answered. So yeah, that's it from me.